is again when it comes back to 0. And your stop loss is at minus 3. If it hits minus 3, you're out. If it goes back to 0, you make money. That is the idea. Alright? And here, because you're doing pair trading, you're doing arbitrage, and because most of the time these stocks are supposed to move in tandem with each other, your success ratios are going to be high. It's going to be 70%, 75%, maybe even 80%. Alright, if you've picked up good stocks to do something like this, you can have a higher success ratio. You can advise this to your clients because he can sleep peacefully at night by buying one stock and selling another stock because he's not exposed to the gap risk. He's not exposed to sector risk. He's not exposed to high beta stock going up 20% and going down 20%. I would not advise you to do that on SBI. Right? Do it on stocks which don't have too much of event, not too much of news flow. Convergent diverges, so that you end up making the system. Okay. End of the day, you watch it at the end of the day, almost towards like 350, 320, what is the ratio? What is my Z score? Is my Z score below minus 2? If it is, then it's time for me to take this trade. You take that trade, right? Usually what happens is that you have your take profit, which is at Z score of 0. You also have your cut loss, which is at minus 3. But at the same time, you also need to have the time bound limit. In how much time is my Z score going to converge? If it does not converge in that much amount of time, you need to get out of it. How would you calculate the time? Now, remember I told you that you need to take 20 days of average in the standard deviation. Okay? Now, if you go back to your high school physics, if you go back to your high school physics, you would have learned something called as a sine wave. A typical sine wave looks something like this. A sine wave looks something like this. This particular portion of sine wave, right? This is where you are entering into the position when your Z score has gone below minus 2, and this is when you are exiting the position when Z score has come back to plus 0. This portion is 1/4 of this entire sine wave. Right? This is one portion, this is another, this is another, this is another. This is 1/4 of this entire sine wave. Alright? And if you have taken 20 days of average and 20 days of standard deviation, you have described one complete sine wave. Alright? So in how many days can you expect the convergence? If you have taken 20 days worth of data and that is your entire sine wave defined, in how many days do you expect the convergence? 5 days? 5 days? Alright? So here in this case, if you have entered the position here, you can expect your convergence to happen in 5 days. So it's like a 5-day trading strategy for you. You advise to your client, after 5 days, if it does not converge, you're out of it. Because again, you don't want to take the risk of holding it for 15 days and not knowing what is happening. After 5 days, you're out of it. Z score minus 3, you're out of it. Z score 0, you're out of it. You know your profit limit, you know your loss limit, and you also know the number of days that you're going to do. If you want to do this faster, you don't want to hold it for 5 days. You want to hold it only for 2 days or 3 days. You don't take 20 days of average and standard deviation. You take only 10 days of average. If you take 10 days of average standard deviation, 1/4 of that is 2.5 days. So you expect the convergence to happen in 2.5 days. If you want a longer period, you take a longer period. So on. So the thumb rule is this: whatever is the average standard deviation you take, 1/4 of that is the amount in which you are expecting the convergence to happen. Alright? Now the trick here of making good money is basically the idea that this is something you don't do a bet sizing on. It's not like Z score agar -2 से -1 आ गया तो इसका मतलब in your favor so you add to it. Right? Here you are playing for pennies. Whenever you do arbitrage, whenever you do pair trading, you are playing for pennies. You are not playing for home runs. You are not playing for a 10% movement. You are playing probably for 1% movement, 1.5%, 2%, 3% kind of. In that, if half the rally goes up and after that you do the bet size, वो transaction cost में बाकी सारा पैसा निकलता है, right? So whenever you are doing it in pennies, right, you want to gather as many pennies as possible. Which means if you are doing it on a Dabur Hindustan Lever, you might as well do it on a Dabur ITC, you might as well do it on a SBI and PNB, you might as well do it on a Sun Pharma and Max. If you have diversified into like 10 different pairs, right, and if you are picking up pennies from each of them, at the end of the day, these pennies will make you good. Right? But you're playing for small percentages. You're playing for 2.5 sort of a percentage. Whenever these conversions would happen, even in 5 days, you would, if it happens faster, if it happens in a day, probably you will make 5.5%. If it happens in 3 days, 4 days, probably 2.5%. The return diminishes rather than the number of days. Alright. So if the conversions happen in 5 days, probably you will make 2.5%. Which means that if you are doing this on 3 lakh long and 3 lakh short, right, you are probably making about 6,000-7,000 sort of rupees, right, in terms of profit. But if you are doing this on too many stocks, right, in the banking sector, you've got like about 10 different public sector banks, which are extremely liquid. At least the top 5 are very liquid. Public sector banks, SBI, PNB, Union Bank, whatever XYZ, right? If you take these banks and if you do, the number of pairs that you can make is enormous amount of pairs, right? Again, within the FMC, you've got 4 good stocks. You've got within the pharma, about 3 to 4 good stocks. You make pair of all of them, you'll have sufficient number of pairs to pitch pair of. And every day you'll find the Z score going to +2 or -2, at least 3 or 4 stocks. There's good amount of money to be made every day. That is the idea. Alright. And if you're looking at so the idea is this ratio that you're tracking, at the end of the day. Right? You can also track it in the last 1.5 to 2 hours. You don't need to be very specific. Usually what happens is by the end of the day the ratio vanishes. It comes to -2 and during the day sometimes then it vanishes. So all the other numbers are fixed. All the other numbers are fixed. Only this ratio of yours is changed. So you might actually check that every 1 hour to see if your risk score of -2 or +2 has been achieved. If it has been achieved, then you basically want to enter into it. Alright, so you don't want to wait till the end of the day because most of the opportunity vanishes by the end of the day. So there are a lot of people trying to do these kind of stuff, trying to come up with these kind of things. So you have lesser amount of opportunity. You want to make sure that you grab it in good amount. Okay. So basically, paid trading and trend following systems are two sides of the same coin. Whenever you do trend following, you're trying to go for home runs. You're trying to make 4, 5, 7% return on a single trade, where you know that these trades are only going to last for 30% of the time. When you're doing paid trading, you're going for many. And your probability or your success ratios are very high, 70-75%. Okay. Do we have more time? You do? Okay, everybody wants to know now. So let me first discuss options. This is clear so far? Alright. Now, what are you currently doing on options? So that will help you build the strategy. Are you selling options or are you buying options? Buying options. Because selling options is very risky. Right? Very risky. Alright. Do you want to know strategies on buying of the options or selling of the options? Good. So let's start with buying of the options and then we'll get into selling of the options. Which is on options. Now, how many of you are not familiar with call and put options? Please raise your hand kindly. I'll start from the beginning. Everybody understands call and put options. No issues with that. Right? What is the call option? What is the put option? So I can start from the level 2, right, of using these call and put options. Alright. Now, suppose that you expect a volatile environment. Alright? You expect an environment where, for example, 5 days down the line you would have this. Alright? So markets are going to be very dynamic. Markets are going to either have a good rally or it's going to fall down sharply. Alright? So you're going to be in a situation where volatility is going to exist. You know that it's going to be a volatile period. Similarly, if you take elections, every election either the market is limit down or limit up. You don't know whether it's going to be limit up or it's going to be limit down. You don't know whether Congress is going to come or BJP is going to come. You don't want to bet on that. You don't want to bet on the direction of the market. Alright? But you still know that there is going to be volatility. You still know that there is going to be some good movement in the market. And you want to capture that movement. Alright? Without bothering about the direction. The beauty of option lies in the fact that any kind of view you have about the market, whether it's about good movement, whether about no movement, no volatility in the market for whatever one complete year, you can make money on it. If you have good view on the market that is going to have huge movement, you can make money on that. If you have view on a particular range, you can make money on that. If you have no view on that range, even then you can make money. The good part about options is that you can play around with it in so many different formats. Alright. So let's assume here that you're trying to predict or you're trying to say that there's going to be a good movement in the market in the next 1 week. Alright. And you want to basically capture the movement. You don't know whether it's going to be in the positive side or on the negative side. You don't want to take a direction. Alright. What you would do is, suppose my market is trading at, do we have one more pen? Suppose your market is trading at 5900. Alright? Which means your spot price is 5900. Okay. Now if I buy a call at 5900 and if I buy a put at 5900, it's called as buying at the money call. At the money call, at the money call. Everybody understands at the money call, at the money call. Okay. So if I buy a call, I have to pay a premium. Right? Every time I buy a call option, I need to pay a premium. Every time I buy a put option, I need to pay a premium. Alright? So suppose that at 5900 you have this view that the markets are going to rise or fall down very sharply because of the budget events. Alright? What you would do is you will buy a call. Alright? You will buy a call, and for buying a call which is at the money, suppose you pay a premium of 50 rupees. Okay? And you are buying a put. So here I bought a call, and suppose I bought a put which is costing me suppose 45 rupees. Alright? So I am already out of the money by 50 plus 45, which means 95 rupees. Alright? I am already out of the money by 95 rupees, which is the premium that I have paid to this market. Alright? Now I am out of the money by 95 rupees. Suppose the market agrees with you and has a good mood, alright, such that it either goes down very sharply or it goes up very sharply. And suppose that your market falls below 5900 minus, this is your break-even point, which is 95 rupees, which means that the market falls below 5805. Alright, if the market falls below 5805, this option of yours, the call plus put combination, will start losing money. Similarly, if the market rallies very sharply, such that it goes above 59.95, because you pay 95 rupees as the premium, so 59 plus 95, 59.95, if it goes above that very sharply, then you start making money. Alright? Idea is, you have bought a call and a put, but you don't know the direction. But if the market has a sharp rally towards, towards on the lower side or on the upper side, beyond a certain range, right? Your call and put option combined together will start. This in technical terms is basically what we say as going long a straddle. Whenever you go long a straddle, you are basically buying at the money call and at the money put, in the hope that if the market has a sharp rally from this particular point or this particular price, right, you're going to basically make good amount of it. Right? Now the problem here is that you cannot rely always on the news events. Budget happens once every year, election happens once every 5 years. But we need to make money every day for us. Right? So we need to do something about it. So what happens is, whenever the market also reaches very critical juncture of supports and resistances, suppose it has got to a very critical resistance level. So let's say 59.80 is a very critical resistance. What happens is, if everybody is watching that resistance level, and if the market has gone to that particular resistance level, you would see a very sharp pullback from there, or if it breaks through that level, you will see a very sharp rally. Either way, that point has become a very critical point. Similarly, on the support point, you might have a very critical support point. Let's suppose at 5750, and if the market comes to that level, from there probably it will bounce back very sharply, or seep through that very sharply. So what you want to do is, instead of taking a view that from here the market should bounce, or from here the market should fall back, you buy a strategy. If you buy a strategy, and if the market gives you a sharp reaction from those critical support levels, you end up making good money. Alright? You are direction neutral. You don't want to take a bet on whether that support will be broken or not, or the resistance will be broken or not. Alright? But you still want to basically make money on that particular thing. So not only on the news event, but also on very critical support and resistance level, you can take a bet. Alright? A close cousin of this . A close cousin of this is, suppose that you don't have a view on a particular price, but you have a view on a range. Suppose you say that as long as the market stays between 58 and 5900, I don't care about it, right? Because this is not going to go anywhere. The moment it goes above 5900, it's going to go all the way to 6100. Or the moment it falls below 5800, it's going to go all the way down. You're advising to your client. You're saying that सर आई थिंक 58-5900 के बीच में रहेगा, कुछ नहीं होगा, उसके ऊपर जाएगा तो अच्छा होगा रैली, उसके नीचे जाएगा 5800 के तो अच्छा होगा. Lot of time you have these views, you know, the moment it's in sideways you don't do anything, moment it goes above this something happens, moment it goes below this something happens, right? So what you do is, again let us assume that 5900 is your spot, and suppose you have a view that as long as the market is between say 6000, not 6000, suppose 5950 and in this level suppose it is 5850, alright? As long as the market is between these two levels of 5950 and 5850, the market is not going to do much. The moment it breaks to 5950 is going to rally, or the moment it goes below 5850 is going to go down further. What you do is you buy a call which is at 5950. So when you are buying a call of 5950 and if you are at 5900, you are buying an out of the money call. Alright, prices which are higher than your spot price have a call which is out of the money. Alright. So for buying an out of the money call, suppose I pay a premium, alright, suppose I pay a premium of 40 rupees on buying a call of 5950, alright. I can also buy a put which is at 5850, which will be an out of the money put. Puts are out of the money for the prices which are below the spot price, alright. So if I buy a 5850 put, suppose I pay a premium of let's say another 30 rupees for buying a put. Alright, I am already out of the money by 70 rupees. I am out of the money by 70 rupees. Now, if the market, you had a view of 5850, if the market goes below this level which is 5830, alright, if the market goes below 5830, and because you had the view that below 5850 it should have a sharp rally down, the moment it goes below 5850, if it continues to go further below 5830, you will start getting in the money. Alright? Oh, I'm sorry. Sorry. As long as the market stays in this range, as long as the market stays in between 5850 and 5950, your 70 rupees is paid as a premium. That is in any way going to decay up to the expiry. Alright? The moment market goes below 5850, you will start making money. Or the moment the market goes above 5950, you will start making money. As long as the market stays in this range, right, your premium of 70 rupees, what you pay to the market will continue to decay every day. What we in technical term call the theta decay. The decay in the price of your premium. Right? Now why there is a decay in the price of the premium? You know, whenever you talk about the price of the premium's price for the call or put option, you always need to think about the premium's price in terms of the risk that the seller is putting. Now at the beginning of, suppose my expiry is on 28 February. On the 1st of February, if a seller is selling you a call, he is carrying a very large risk. Why? Because if your spot is at 5900 and if he is selling you a call of 5950, he is holding a very large risk because he has got 28 days to expiry and the market can easily go from 5900 to 5950. Alright, and if because the market can go easily from 59 to 50, 5900 to 5950, he has a very large risk of selling you this particular option. So he needs to be compensated for it. If he needs to be compensated for it, he will demand a larger premium because the risk is very high. But suppose for the expiry to the market only 2 minutes are remaining. 28 February, suppose 3:28 a seller is selling you a call option of 5950 and spot is 5900. What is the probability that in 2 minutes market will move by 50 points? Very less. Which means there is no risk of the seller. If there is no risk to the seller of selling a 5950's call when market is at 5900, that means he is going to get lesser amount of fees. Alright? Everything else remaining the same. Everything else remaining the same. Market staying at 5900. Your premium every day keeps decaying because the risk of seller every day decreases. Towards the expiry or the day of expiry, last half an hour, 10 minutes to expiry, there is no risk. That's why the premium price comes to 5 paise. At the beginning of the expiry, the premium price is 100 rupees because the seller has got very large risk that is taking. But the moment it comes towards the expiry, the risk keeps decreasing. And that in technical terms we call it the decay of theta, or the decay in the time value of your option. Alright? Now, as long as your market stays in this range of 58.50 and 59.50, right, and it's not moving, it's not going anywhere, you say there's no movement in the market. This premium that you have paid of 70 rupees, you have already paid from your pocket, it's gone from your pocket. Alright? The value of that keeps decaying. The value of that 70 rupees that you have keeps decaying. You had paid 70 rupees, it becomes 30 rupees, 20 rupees, 10 rupees, 0 rupees, 0.5%. And entire amount of your 70 rupees is gone. Alright? But if the market breaks through 58.50, if the market breaks through 58.50 or breaks through 59.50, and you are assuming that after this range there is a sharp rally which is going to come. The moment there is a sharp rally, right? What happens is from 58.50, the market has to go down another 70 points. Because you have paid a premium of 70 rupees. So 58.50 minus 70, which is 57.80. After 57.80, if the market continues to go down, your put option will start picking. Alright? Similarly, on the way up, after 59.50, another 70 points, which is 6,020. After 6,020, the market continues to rise up. Then basically your call option will start. Between this range, your premium will continue to decay. After this range, your premium will start, gaining some momentum. After this point, your break-evens are going to